All right, what's a Section 179 depreciation deduction? So far we know that personal properties depreciated double declining balance. 5-year property includes computers, light trucks, and farming equipment. 7 years, heavy equipment, machinery, and office furniture. And that's the rules for personal property. Property used in business, but it's not considered real estate. For real property or real estate, we don't use double declining balance, we use straight line. 27.5 years for residential, 39 years for commercial. And these makers rules are considered normal depreciation rules for tax purposes. Management does not get to come up with their own useful life under makers tax depreciation rules. This is all determined in advance by the IRS. It's different in accounting, where management gets to estimate the useful life, and depreciation simply allocates cost of an asset with an expense taken on the income statement over the periods benefited. For tax purposes, depreciation is about being able to take an actual tax deduction, save income tax based on a newly acquired machine, and the IRS makers rules usually apply. We said 5 years for computers and light trucks, 7 years for equipment. Here's the question. Is there ever a time where you can get the tax write-off in full in the year of acquisition rather than over 5 or 7 years under makers? And the answer is yes. That's where Section 179 comes in. Because Section 179 is like depreciation on steroids, because the entire cost is deductible in year one. Section 179 only applies to tax depreciation, though, never for the income statement. So to encourage smaller businesses to expand, the first amount spent each year for new or even used machinery and equipment can be deducted immediately rather than being depreciated under normal makers rules. And this amount is referred to as a Section 179 deduction. Now, the Section 179 amounts and limitations change almost every year, so you don't have to memorize it. The exam will likely provide you the amount, and then you'll have to know what to do with it. For example, business use vehicles qualify under Section 179 too, if used more than 50% for business purposes. So we have machinery and equipment qualifies, and so does business use vehicles. Qualifies for what? An immediate write-off in year one of the full amount spent. But to take a Section 179 deduction, the business must be profitable. The deduction cannot create a loss or add to a loss. And the new asset must be purchased from an unrelated party. That means an arm's length transaction. And Section 179 is not allowed for buildings. And you have to actually own the property. You can't lease it. You could finance it, but it has to be something you're buying, not leasing. All right, what is the primary purpose of the Section 179 deduction? A, to provide tax relief only for real estate investors. B, to require businesses to spread deductions over the useful life of an asset. C, to encourage smaller businesses to expand by allowing an immediate deduction for qualifying asset purchases. D, to provide the same depreciation rules for tax purposes as for financial accounting. And the answer is C. Section 179 is designed to help smaller businesses grow by permitting them to deduct qualifying equipment purchases in the year acquired, deducted in full, rather than capitalizing it and depreciating it over multiple years. This tax incentive makes it easier for businesses to invest in assets, encouraging them to do so by reducing their taxable income in the year of purchase. A is wrong. To provide tax relief for real estate investors, Section 179 is not available for real estate assets. And B is wrong. To require businesses to spread deductions over the useful life of an asset? No. And D is wrong. To provide the same depreciation rules for tax purposes as for financial accounting? No. Section 179 is only for the tax return. It does not exist under financial accounting rules. And the question asks, what's the primary purpose of the Section 179 deduction? And the answer is C, to encourage smaller businesses to expand by allowing an immediate deduction for qualifying asset purchases. All right, which of the following businesses would not qualify to take a Section 179 deduction? A, a profitable small business that purchases machinery for use in its operations. They would qualify. B, a corporation purchasing office computers in an arm's length transaction. Arm's length means it's not related party. They're buying from an outside party, so that qualifies. A and B are out. C, a sole proprietorship that is operating at a tax loss for the year. Okay, they would not qualify because the Section 179 deduction cannot be taken if it adds to a loss or creates a loss. D, a manufacturing company purchasing equipment from an unrelated supplier, they'd be allowed to take a 179 deduction. So letter C is correct. To take a 179 deduction, the business must be profitable in the tax year. A business operating at a loss cannot use Section 179 since the deduction cannot create or increase a net operating loss. And the question asked which of the following businesses would not qualify to take a Section 179 deduction, and the answer is C, a sole proprietorship that is operating at a tax loss for the year. Now, the actual dollar limits of Section 179 not usually tested on the exam. In fact, they'll usually give you the limit. But you should know now the first $1,250,000 of the cost of acquiring new or even used machinery and equipment and office furniture and software could be expensed immediately. However, once the taxpayer spends over $3,130,000, the allowable amount of immediate deduction is lost dollar for dollar. Therefore, if your total equipment purchases for the current year are $4,380,000 or more, the Section 179 deduction is completely phased out, and you can take whatever other depreciation is possible. You can always take maker's depreciation if you lose out on Section 179. Of course, not included in Section 179 rules is land, which doesn't depreciate at all, and building. Buildings are not subject to 179. We know the rules for buildings. It's either 27.5 for residential or 39 years for commercial. All right, so if the limits mentioned are applied, $1,250,000 and then the upper limit of $3,130,000, what amount can be deducted if Company A spends $1,001,000 for machinery and equipment and Company B spends $3,620,000? Well, let's look at Company A. They spend $1,001,000. That's below the $1,250,000 annual limit. So Company A can deduct the full $1,001,000 that they spent without having to use normal depreciation rules. But Company B, they spent $3,620,000, and the upper phase-out limit begins at $3,130,000, meaning they went over. By spending $3,620,000, they went over the upper limit by $490,000. And the result of that is the Section 179 deduction for this year will be reduced by that $490,000 excess. So instead of taking $1,250,000 immediately, they can only deduct $760,000 right away this year. So Company B can deduct $760,000 of the $3,620,000 under Section 179. The other $2,860,000 that Company B spent can be depreciated using other depreciation rules like makers. All right, let's try this. Darby Corp and Galt Corp are both purchasing machinery and equipment for their businesses. The Section 179 deduction limit for the year is $1,250,000, and the phase-out threshold begins at $3,130,000. And that's typical of the exam. They'll tell you that. Darby Corp purchases machinery and equipment for $992,000. Galt Corp purchases machinery and equipment for $3,004,000. What's the maximum Section 179 deduction each company can take? And the answer is B. Darby Corp can take the full amount spent, $992,000, while Galt Corp can only take $980,000. Let's see why. Well, Darby, very straightforward. They spent $992,000, and that's below the annual limit of $1,250,000, so they can deduct what they spent, $992,000. But that doesn't help us answer the question because A, B, and C all suggest that Darby can deduct $992,000. So let's look at Galt. Galt Corp exceeds the phase-out threshold by $270,000 because they spent $3,004,000 and the phase-out starts at $3,130,000, and that reduces their maximum annual deduction to just $980,000. Right, $1,250,000 minus $270,000. Because when you go over that limit of $3,130,000, you lose the immediate deduction dollar for dollar. So instead of being able to take $1,250,000, Galt can only deduct $980,000 this year, and they can take the rest of it through normal depreciation rules. So the question asks, what's the maximum Section 179 deduction each year that the company can take? And the answer is B. Darby can take $992,000, but Galt can only deduct $980,000. Notice that even though Galt Corp spent a lot more than Darby, Darby gets more of an immediate Section 179 deduction than Galt because it's not based just on the dollar amount of what you spent. It's based on what you spent compared to the threshold. Darby didn't go over any limit, but Galt did. They not only went over the $1,250,000 limit, they also went over the $3,130,000 limit. And that means Galt Corp can deduct the remainder of what they spent, $3,400,000 minus the $980,000 immediate deduction, $2,420,000. They're going to have to use other depreciation rules like makers to start deducting the rest of that.
All right, let's try this. The REG Corp, profitable company, purchased the following assets in the current year and wants to take advantage of the Section 179 deduction to save taxes in the current year. So what do they want to know? How much can they deduct under Section 179 for the current year if the annual limit is $1,250,000? And if you think you know, leave me the answer in the comments or community section. And if you found this video from I-75 Reg helpful and you want to see the end of it and more videos like it, get yourself on I-75 with me, Darius Clark, because the right teacher makes all the difference. Go to i75cpareview.com. I'll leave a link in the description.